Well, good afternoon, everybody. Thank you so much for joining us for our quarterly market review. We are going to be talking about the first quarter of 2016, and we'll be talking about the economy domestically and globally. We'll be talking about the stock market. We'll be talking about the bond market, and we'll be talking about where we think we're going to go from here. We are waiting for a few more people to join us, and in the meantime, we are going to get started talking about where we are going to look at an overview. So we're going to go through the same sorts of slides that we've done historically in this market report. We're going to be looking at the market summary, world stock market performance, world asset classes, U.S. stocks, international emerging growth, looking at how the different countries are performing. There are vast differences in what's happening with different countries right now. Talking about real estate and how well that's performed lately, as well as commodities, fixed income, which you would think of as bonds, and then global diversification. Moving on, we're going to start looking at the market summary, and before we get started, we want to throw a poll out to the people who are signed on with us. And the first question is, do you think that the stock market will be positive, flat, or negative for 2016? So if you want to go ahead and log in now, then we'll let you know what the other people on the call are thinking. Okay, fantastic. That is a great response. So 50% positive and 50% flat. And now we're seeing there's going to be a little bit more people that are looking at having a flat performance. It's great that we're not seeing a negative performance. So we have a better opinion about the stock market than we did the last time that we sent out this poll. So we're going to close that one and open up the next poll that we're going to be looking at. And we're saying, are you concerned about the economy? And that's just a straight yes or no. Okay, pretty consistent answer there, and that is yes. And that is not a surprise. I think most of the clients that we're talking to these days are concerned about the economy and where we're going from here. So we are going to move on to the next polling question. And the last polling question that we have is, are you more optimistic about the domestic stock or the domestic bond market? So when we say domestic, we do mean the U.S. stock market or the U.S. bond market. And we are saying, do you think that, which one of them do you think has a better outlook for 2016? Okay, fantastic. Thank you, everybody, for participating. That's great. We saw in the beginning there we had 100% votes for the domestic stock market. We are now landing at 80% on the domestic stock market and 20% on the domestic bond market. So I want you all to think about those numbers as we go through the rest of the return numbers. I'm going to go through a whole bunch of information at the beginning. We're going to skip through some slides fairly quickly towards the middle. And then we're going to talk at the end part of it about long-term investing, global diversification, and what it actually means for investors who are trying to achieve their financial goals. So in looking at the slide that we're on right now, this is a great slide to indicate that if you fell asleep on January 1st and woke up on March 31st, you would have thought, well, that was a pretty calm quarter in the market. And as we all know, it was anything but a calm quarter in the market. So we had the worst start to the stock market year ever in the history of the stock market. But in the end, we actually ended up 0.97%. The international developed stocks were still down 1.95%, and I want you to remember that number also as we go through some of these slides. Emerging market stocks surprised all of us and jumped up 5.71%. You might say, well, gosh, we should start looking at emerging market stocks. What we'll see as we go through a little bit later is that those have been negative for so long that they're just really making up for some lost time. Global real estate is up 6.94% in one quarter. And so you might say, well, is that the same kind of story as emerging markets? Has that done so poorly that that's just a really a rebound number? And what you'll see a little bit later on is that that is actually a consistent positive return that we've seen from global real estate. And we have enjoyed those returns quite a bit. On the bond market, the U.S. bond market was up 3.03%, and the global bond market was up 4.16%. So when we talk about expectations for returns for 2016, on the poll, we had an 80% domestic stock market, over 20% in the domestic bond market as far as our listeners and what they favored. And what you see in the first quarter, at least, is that the bond market did significantly better than the U.S. stock market, surprising most market watchers. Moving on then to look at world stock market performance. This is one of the slides that we're going to spend a whole lot of time on. And in the beginning, on the far left-hand side, we're going to talk about why the beginning of the year was really, really harsh in the stock market. We had some unusual things that happened that were very scary to the stock market. What the stock market hates more than anything is uncertainty, and we really started out the year with anything but certainty. So the China market drop leads to worries of further turmoil. We just need to get used to China being a concern for us. What we did see last year in August was that China devalued their currency. They are actively moving towards more of a consumer-driven economy. They've been very much in a manufacturing economy. It's done well for them for a long period of time, but the party has to end, and they realize that. So they are now moving into a consumer-driven economy. That transition will probably take 5 to 10 years, and they will probably do it with lots of fits and starts. It is very difficult to combine their communist background with their goals of capitalist free markets. And so they are going to be implementing different policies, trying them out, and so we should expect for the China market to have lots and lots of volatility as they go through this entire transition process. We also have to understand that they are a major economic player. They're the second largest economy in the world, and we have to understand that China and the U.S. do affect each other. They are not one of our major export partners, so they don't affect our economic returns very much. But when China falls and our U.S. stock market falls with it, then we have to understand that that's going to be an ongoing factor for us to consider. As I mentioned there on the bottom, the Dow and the S&P started off to the worst starts ever for any year. That's significant, and that's why we saw some major market watchers saying things like, well, maybe it's time to go to cash. Maybe this is the bear market. Maybe this is the repeat of 2008. Maybe this is when we need to pay the piper. We did not believe that that was the story. We believed in a rebound. We believed that the economy was strong and steady, which is what we still believe. Nonetheless, when we have a start like this, what we do need to be aware of is that the volatility level that we have is probably here to stay for at least the next 24 to 36 months, in which case long-term investors should either get used to that or they need to let us know that that is not something that they can tolerate in their portfolios, in which case we will look at how we can reduce their risk for them. So this is a great time not to necessarily be an investor, but to test yourself as an investor. If you can handle significant volatility in the market, then there are going to be returns for us. If you can't handle volatility, that's a conversation we would like to have with you sooner rather than later. The other piece of it is, as you'll see, there's that oil skids to a 12-year low. It's interesting to note that oil does not have nearly the same kind of effect on the stock market that the housing market had in 2008, but certainly you would have thought that they had the same connection back in the first quarter. Oil fell down into the mid-20s, which was not predicted. It was highly unusual. There was no cohesive plan about what we were going to do about oil supply and demand. There was no hope for oil prices coming back up. The prices kept falling and falling and falling after a very rough 2015. And obviously here in Texas, we feel that a little bit closer to home than in some other states. So that was a huge concern for the stock market. And even though there are lots of economists who can point out why lower oil prices would actually be good for some companies, that is not what was reflected in the stock market. So the uncertainty around oil, the questions about why is it falling so low and when is it going to recover, really unnerved the market fairly significantly. The next big issue that we had was the Iran sanctions end as the deal takes effect. And so that's not news. So the three things that we have on the left-hand side, China, oil, and the Dow, those were new to us this year. The Iran sanctions, that we'll have trouble with Iran probably for the rest of any of our lives. And so that's not something that we have any concern about, but that was a major effect that happened in the beginning of the year. We then saw the Bank of Japan introduce negative interest rates. And I'm going to spend a little more time on this than I normally would. But when we talk about negative interest rates, we talk about something that has never been tested before. The Bank of Japan is not the only bank that's doing it. We are certainly not doing it here in America, but unfortunately our Fed has not patently said that they are refusing to do it. They are saying that they are exploring the opportunities and what that would mean. Negative interest rates mean that you pay the bank for them to hold your money. So as that sinks in, I want us to consider that that has never been done before. It's been done very recently over in Europe, but in the history of any of us who are managing money these days, this has never been done before. It's a brand new policy. In my opinion, it's a very dangerous policy. It is completely untested, and nobody knows how it's going to turn out. So maybe this is some strange paradigm shift that will work out just fine in the financial markets. But as I keep saying, this is a stranger and stranger time to manage money. And these negative interest rates absolutely give me concern and absolutely are going to teach us a whole new world about what they can mean for consumers. The goal of something like negative interest rates is to try to get money actually out of the banks and into investments, whether that's companies that people are investing in or stocks or bonds. What the Bank of Japan is trying to do is to motivate investment and motivate consumers to do something other than keeping their money in the bank. So far it's not working. I will be very surprised if it does work, and I'll be eager to see on the other side of it what exactly is going to be the ramification of that. I don't see that as a positive move. Now as we move further on to the right, the news that we've had, some of it was negative, but honestly a lot of it was positive. So the Nikkei had some issues with the largest weekly percentage drop since the financial crisis toward the middle there. But then the U.S. economy is starting 2016 on solid footing. Global currencies soar, defying central banks as we move over to the right-hand side. On the bottom there, net worth of U.S. households rose to a record $86.8 trillion in the fourth quarter. Those are all positive signs. What happened in the meantime also, as you can see that the market moved up, is that oil got back on track. Oil is now trading in the mid-40s, and so we've recovered from the panic around oil. The other piece is not on here, but I would be remiss if I didn't mention it, is Donald Trump and the presidential election. Just as lots of people have tried to count Donald Trump out, you also cannot count out the stock market. Both bears and bulls did not see the kind of rebound from the February lows that we have had lately. In fact, we closed today over 18,000 on the Dow. So we did not expect that. We certainly did not expect that, and I would say people on both sides who thought that the stock market was doing well or was about to turn into a big bear market, neither side really thought that that was going to happen. So we need to be careful as we talk about all these new risks to the stock market, that it doesn't mean that the stock market can't make money, but what it probably means is it won't make as much money for us going forward as we have expected historically. We are now going to move on to the world index and what's happened over the past 12 months. So I don't want to belabor this because a lot of what is on this slide was also on the last slide. But what we will see is that the market reached its high in May of last year. So this goes back a full 12 months. So we saw that the market reached its high in May, and the one-year numbers are going to start looking better after we get to May. And looking out in June and July, when we start looking at that performance, in 2016, those numbers are going to improve significantly, because right now, if we look back at one-year numbers, basically what we're seeing is a measure against the high of the stock market. And again, we saw some positive things here. So right in the middle, the U.S. second quarter GDP grows 3.9%. That's a nice, healthy number. One of the reasons that we strongly believe in the U.S. economy is that the U.S. economy has never gotten onto a major growth spurt the way that you would normally see after a recession that we saw in 2008. So because we have really just been mounting small amounts of GDP growth since 2008, we've not gone on a big surge that we need to fall off from. I still believe that the U.S. stock market is strong. I would bet on the U.S. stock market or the U.S. economy, over any other economy in the world, and I would have that expectation for the next 3 to 5 years at least. I don't believe that we are going into a recession. I don't believe that we have a recession on the horizon. Everything that we see is strong right now. We'll talk a little bit about what the Fed announced today and what their opinion is of the stock market and of the bond market. One thing that is important to see that's not on this particular chart is that China did devalue their currency back in August, so that's really that big downturn. And that's around the time that we had that 1,000-point drop on the Dow, which was the largest drop that we had ever seen. Those are numbers we need to sit up and pay attention to. So when we are here in our office and we see those things going on, we don't say, oh, well, it'll recover, it'll be just fine. We certainly are looking at those items and saying, well, how much risk is that bringing into the financial markets? Does it change our understanding of risk? Does it change our understanding of the performance expectations? And should we be reallocating in response to that? We have reallocated our portfolios through the end of last year. We continue to do so this year. And one of the main things that we're looking at is, as this chart indicates, there's just more volatility right now. And because of that, we believe that our job is more about reducing risk than it is trying to get extra growth. We don't want to bring so much risk into our clients' portfolios that then we would have too much risk and it wouldn't be worth the growth reward that we would get on the other side of it. So we would rather accept that the stock market may have some subdued returns, be really clear with our clients about that rather than bringing unnecessary risk into their portfolios that they may or may not be aware of or on board with. Another thing I want you to be aware of here is on the bottom side, the IMF downgrades the global economic outlook again. That was at the end of last year. They did it again this quarter. And it is important for us to see that the IMF, which is the International Monetary Fund, and looks at the entire globe and where growth is going to come from, opportunities both in the U.S. and all the other countries in the world. They are looking at where is the world going, how are all of the countries, the imports and the exports affecting each other, where are we going to be able to see growth that in one country might be able to spur growth in another country. And the IMF has continued to downgrade their expectations of growth. Right now, there's still over 3% for projected growth for 2016, but it is important to know that they've been downgrading that, and we have to be aware of that, obviously, as managers, as we look forward to where we're going to place our clients' assets. So let's look at how the world asset classes performed. This is the first quarter 2016 index return. So again, that real estate number that we looked at on the very first page in the first quarter, 8.6% on the U.S. REIT index, emerging markets 7.79%, the emerging markets index 5.71. So lots of big numbers at the top, but really real estate and emerging markets are generally going to represent no more than 5 to 15% of a globally diversified portfolio. So those are great numbers, but they're in a really small percentage of the portfolio. The bottom part, starting with the Barclays U.S. Aggregate Bond Index all the way down to the Russell and the emerging markets and the World Value Index at the bottom, that's really where the majority of portfolios are going to be invested between stocks and bonds. So if we look at that middle part, there's really not a lot of great returns that we had in the first quarter. Again, we landed in a much better place than we thought we might have landed when we were around mid-February or so. We did come roaring back, but when all is said and done in the first quarter, a lot of the returns either canceled each other out or they were just barely positive. Now breaking it down into the U.S. stocks. So the previous slide that we looked at was world stocks. This is now U.S. stocks for the first quarter of 2016 index returns. And again, I'm going to highlight a couple of important things for you that are really interesting for us to look at as money managers. So if we look at the period returns, I'm looking at the bottom right-hand corner of this slide. The market return was 0.97% year-to-date. The large cap was 1.35, and then if you look down to just plain small cap, it was negative 1.52. If you look at those same lines going across the top, market-wide, the 3-year number is 11.15, which is a great number. The 5-year is 11.01, and the 10-year is 6.9. The large cap numbers follow those fairly closely, but then small cap is an interesting story. So normally, if we would look back on a chart of stock market performance since the beginning of time, you would see small cap on the top, meaning that they have had the best returns over the lifetime of the stock market. But if we look at it today and look back over a 3-year number and a 5-year number and then look out to a 10-year number, those numbers actually are about half in the 3-year and 5-year section of what large cap did, and it's just about on par with what large cap did over a 10-year period. But small cap only performed at 5.26%. So when I first started in this industry, we would expect a stock market return of about 8 to 10%, and the stock market over its lifetime had returned fairly close to 10%. Now when we look at these 10-year numbers, which is a very long market cycle, we're seeing that none of these numbers measure up to the 10%, and only large cap growth is even at 8%. So we're going to build the story as we go through it, and you can see what happens as we get into a globally diversified portfolio. On international developed stocks, the story is much worse than what happened in the U.S. So if you look at year-to-date, those numbers are almost all negative. And again, looking at the bottom right-hand corner, if we go out 3, 5, and 10 years, those numbers are what I would call paltry. So in the international developed stocks, we would expect the same sorts of returns that we would expect on the U.S. stock market. And we can see here that on a 3-year, 5-year, and 10-year number, that we did not receive that on the international side. If you look at value, value is basically flat over a 3-year, 5-year, and 10-year period. So what those numbers are telling us is that if you were invested for 10 years in an international value index, that one that is measured there, then the return would have only been 0.76% on a year-by-year basis, but you were expecting something closer to 6, 7, or 8%. So this is important for us to realize what we are expecting of the portfolios and how the portfolios are actually performing. On emerging stocks, I told you that the year-to-date numbers are fantastic, but we shouldn't be fooled by those. So we can see here that on the 1, 3, and 5-year numbers, they are all negative, and they're negative to a fairly good tune. On the 10-year, we are positive there, but just barely. And the last time we looked at this slide in the last quarter, all of these numbers were negative. And then looking at select country performance, some of these numbers had really great returns: Brazil, Peru, Colombia, Turkey, all places I don't want to put my money. And so there are some great returns there, but we don't invest our clients directly into any of those countries. One of the things that I do want to bring your attention to is on the left side, the ranked developed market returns. If we look down at Japan, which is third from the bottom, the return is negative 5.68%. So if you remember back at the beginning when we talked about the negative interest rate policy in Japan, well, Japan has been on a very active, aggressive, and purposeful economic manipulation policy. And by manipulation, I just mean that they are very, very involved. The Bank of Japan is very involved in trying to get their economy back on track. So I'm not saying manipulation in a negative way. I'm saying that they are being very purposeful about the moves that they are making right now. They have been trying to spur inflation because they have not had inflation in so long. Their interest rates have been pegged at 0 for many, many, many years now. And so now they've moved into this negative interest rate policy. There were some big players in the financial markets who made big bets on Japan. They said this thing is going to work, at least temporarily. And now what we're seeing, at least in the first quarter, is that we have a fairly significant negative return, 5.68%. The U.S., the return there was 0.77% by comparison. So again, we'll circle back to real estate investment trust. This is for the first quarter of 2016. U.S. REITs had a return year-to-date of 5.12% in the bottom right-hand side. Global REITs were at 8.6%. But then if you look at the 1-year, 3-year, 5-year, and 10-year numbers, you can see that the U.S. REITs had fairly significant returns over the global REITs. Additionally, global REITs tend to be more volatile for a U.S. investor. So we don't tend to bring in as much global real estate in the portfolios as we do on the U.S. side. I also want to point out the consistency in the returns here, and I want to point out that on the 1-year, 3-year, 5-year numbers, or at least on the 3-year and 5-year numbers, those are closer to the returns that we would like to be able to see in the portfolios. And that's one of the reasons that we have added real estate and will continue to add real estate into our clients' portfolios. Commodities have been just a crazy story, mostly focused on oil, and oil is finally back in a rebound state. But really, if you talk to anybody who works in oil, they might say that we think that oil is going to go back up above $50 a barrel this year, but they're really just crossing their fingers and hoping that that actually happens so that people can become profitable again. What has been interesting to see is that the companies that are drilling domestically, they still want to be able to make money in oil. That's what U.S. companies do. And so they have gotten even more clever about the things that they're doing with technology and fracking, so that as soon as it is profitable, that they're going to jump in with 2 feet. We do believe that as soon as oil gets to a number back above 55 or 60, that we'll start to see oil production come back, and hopefully that sector of the market will explode again. We do not directly invest in commodities, but it is interesting to see the disparity here between what's happened with gold and natural gas and all of the other different commodities in between. So fixed income has been a pleasant surprise for us. A lot of people have counted fixed income down and out for the last 2 years, and mainly the reason is because the Fed stopped their quantitative easing policy in 2014. Quantitative easing was when they decided to buy bonds out of the marketplace and replace it with cash. The whole idea was to get cash out into the marketplace so there would be liquidity, so that people like you and I would go do things like buy homes and cars and start businesses and feel like there was free cash flow that we could borrow and help to grow the economy. They did get the real estate market started. They did not kickstart the economy as much as they had hoped, so they came out of that policy in 2014. They finally raised rates for the first time in December. There was some discussion from some of the companies that rates would be raised 4 more times this year in 2016. I never believed that. They have not raised rates yet this year, and based on the commentary from the meeting today, they will not be raising rates in June. The only reason that they have to raise rates is really to get back to a normalized interest rate policy. We would love to see a normalized interest rate policy, but we would not love to see it at the risk of the U.S. economy continuing on the path that it's on right now. So I'm happy for the Fed to just maintain the 0.25% interest rate target that it has right now. What that means, though, is that we would expect that we're still not going to have great returns on savings at the bank. I've had 2 conversations about that today with clients who are saying, when are we going to get back to the good old days of being able to get 3, 4, 5% at the bank? And I said it'll probably be at least 5 years if we stay on the path that we're on right now. So how does the Fed policy affect the fixed income or the bond market? If we think that the Fed is raising interest rates, which many people still do, then we would think that bonds would lose money. For all of you who listen to my dad for many, many moons on the radio, he always used to talk about having a pencil on your finger to figure out how interest rates and the value of bonds work. So if you put a pencil on your finger and think of interest rates on one side and the value of a bond on the other side, if interest rates go down, then the value of the bond is going to go up, and if interest rates go up, the value of a bond will go down. We have had this policy in place from the Fed with the quantitative easing for so long that that sort of an inverse reaction does not always work anymore. So that's how things used to work when I first started doing this, but now we have a whole lot of other market forces that are in play. So when the stock market decided to start the year with its worst year ever, it actually caused a whole big flight to quality, and flight to quality means that investors go over to bonds. So what we've seen year to date is that we have great numbers on the fixed income market, and so we've been very pleased with our bonds that we have this year. We have U.S. government bond was up 8.06%. I don't think that was predicted by many people. And then if you look at the Barclays U.S. Aggregate Bond Index, and so that's the most general one. That one has all the different sectors in it. That one was up 3.03% year to date. The 1-year number on that is 1.96%. 3-year at 2.5%, 5 years at 3.78%, and the 10 years at 4.9%. It's important when we're looking back at those numbers to realize that 10 years ago we did not have all this crazy quantitative easing and negative interest rates going on in the world and those sorts of things. So we don't anticipate that we will get the bonds back to a 4.9% number. Probably the 1-year number of 1.96 to the 3-year number of 2.5. That's closer to the expectation that we would have over a longer current market cycle from fixed income. You also see municipal bonds second from the bottom, year-to-date return 1.67, but the 1-year, the 3-year, and 5-year, nice consistent performance for us. So now let's look at global diversification. So our portfolios are globally diversified. Some of our clients are very conservative or might have a specific issue that they're trying to address in their portfolios, and they may not be globally diversified. But for the most part, our firm believes in global diversification, and we believe in long-term investing. We do not believe in timing the market. We believe in time in the market. And so we don't run from one sector to another. We do make smart decisions based on what we believe the market will do over the next 12 to 18 months. And we try to look back historically to the points in time that we have the same sort of setup as we do right now. So really only the last 2 years really applies to where we are right now, because prior to that, those sorts of factors don't exist anymore, quantitative easing and so on that we've already talked about. So looking on the bottom left-hand side, if we look at the period returns, someone who is in a 100% stock portfolio over a 10-year period, the top line and looking all the way over into the right-hand side, we would generally expect that number to be 8, 9, 10% if we were looking at a long market cycle. And it's only 4.63%. So 100% stock, generally considered one of the highest risk kind of portfolios that you can have, and only a 4.63% number over 10 years. The 3-year number is 6.1, the 5-year number is 5.8. So in no time period that probably any investor would look at and consider it to be relevant do we see that 8, 9, 10% number that we would be shooting for. If you then look at the asset classes and look at 75-25, so 75-25 means 75% stocks, 25% treasury bills, 50-50 is a split between the two, then 25-75 is 25% stocks, 75% treasury bills. You see that in none of those areas do we see a 3, 5, or 10-year number that is where we would want it to be, 6, 7, 8% on some of those balanced, globally diversified portfolios. So it's important for us to be able to see this. It's frustrating, I can tell you that. It's frustrating for us to see this because we would like to be able to deliver better results, and part of what we deliver is what the markets do for us. And so if the stock and the bond markets are not doing what we would expect them to do over a long market cycle, it is harder to deliver anything better than that to our clients. But this is very important information for us to look at, It's very important information for you to look at, and one of the things that we're looking at now is if we have a lower expectation going forward of what the stock and the bond market will be able to deliver to us, and if we think that going forward we'll be closer to these numbers here that we're looking at historically, then how does that change what we are doing with our clients who are taking income out? How does that change for our clients who have accumulation goals? And what should we recommend to them when we're doing our modeling for their retirement, for their education planning, for their estate accumulation, and other life goals that they have? So we're looking at that very seriously internally here. As you all know, everything is stylized to each one of our clients and to what their goals are, so I don't want to make any specific comments here about how we'll be changing that, but you can expect to hear from me over the next year or longer about how we'll be addressing some of these issues and how we are going to be looking at the asset allocation, again with the goal of creating as much positive return as we can, but more importantly, staying away from the risk side of what the stock market and the bond market can present to us at the time. I hope that you all have enjoyed being with us today. We are going to give you a really quick update on where we are currently in the return numbers. So these numbers that you're looking at right now were the quarterly numbers. And so currently today, with the market being a little bit better, I do want to end on a positive note for you. So this is the index performance numbers on the stock market, and we'll see the bond market in just a moment. Year-to-date as of yesterday. And so the year-to-date numbers, if you look down kind of towards the middle, there's the YTD column, and you'll see that the U.S. numbers are actually very strong. We only still are posting negative numbers in U.S. growth, U.S. large growth, and U.S. small growth. So what we're seeing in the core and in the value, we're seeing nice, strong, positive numbers. If we look down at fixed income, which is the bond market, you will also see that those year-to-date numbers are pretty much in line with what we saw on the quarterly side. And again, some nice, strong numbers in places that, quite frankly, we didn't expect it. We expect all that to normalize and to see the returns go back to more of a 3 to 4% return by the end of the year. So we are in a positive place right now, but we have to ask ourselves, is the market very different right now, or is the economy very different right now than it was back in the beginning of February, when there were some big-name players talking about going to cash? And I don't believe that anything has changed. I believe that it is going to become more and more important for us to have conversations with you about where your risk tolerance is, and then for us to be confident and courageous on your behalf as we go through this stock market volatility and make sure that we're on the right path, that we don't make bad decisions when the market does take a temporary downturn, and as always, that we stay alert that if there's something bigger going on, such as a possible bear market, then we are focused on that and make the correct moves ahead of time. We did get a question from one of our clients, which I appreciate, ahead of the call, and they said, well, the question was, what should we do if there's a bear market coming? Do we see a bear market coming? I don't see a bear market coming on the horizon ahead of us. Now, to be fair, we did see a bear market in small caps earlier this year. It was very, very, very short, but it was a true bear market. We saw a correction, which is a 10 to 20% return. We saw a correction on large cap, and we saw a bear market on small cap. And so we do need to be aware that that was in our very recent past, and we could certainly see that sort of volatility again. I believe that we'll see volatility through the end of the year, but I think that the market right now is waiting with bated breath on how the presidential election turns out, and a lot of 2017 will be determined by what happens on that particular date. So we are not making big decisions right now to move into cash or to get more conservative unless our clients are saying to us, I can't stand it anymore and I don't want to be in the stock market, in which case we've got lots of good opportunities to reposition so that we can take the risk down and still be able to meet the financial goals that our clients have. Again, I thank you so much for joining us today. If you have any further questions, either about your particular portfolio or anything that we talked about today, I would welcome them. We really appreciate that you are clients. Many of you are very long-term clients, and we appreciate you being a member of our family. Have a great afternoon.